All right, today we're going to talk about rental property investment. What are the pros? What are the cons? How to analyze a Schedule E, which is their income statement, how to calculate a cash on cash return on investment, some things that you should do, some things you shouldn't do, and then some of the forms that are needed to handle these transactions. Okay, now let's talk about the pros of investing in real estate. So cash flow, you can make a nice return if you're careful and you do it the right way. You can find properties that will provide enough rent to pay off all the expenses that you're expecting and provide some additional cash after all the expenses are paid. The tenant's rent payments will take care of your mortgage payment. So you're going to use other people's money to pay off your mortgage and those various expenses. Appreciation. So number 3 is appreciation. So if you find decent properties, you can expect them over time to go up in value 2%, 3% a year, sometimes more, sometimes a little bit less, but you can expect that the property will go up in value over the years. The other item is it can provide a tax shelter, so a depreciation expense. And what that is, it's a non-cash expense. So for example, you had a $100,000 property that you bought. You can't deduct the land, you can only deduct the building. So let's say 15,000 of that 100 is associated with the land. So you can take the $85,000 that associate with the building and deduct it over 27 and a half years. That non-cash expense helps protect your normal income that you're generating from that property. It's a diversified investment. So real estate's different than the stock market. The stock market could be down in a year like it was last year in 2022, but real estate didn't go down. Real estate went up in most markets. So it can help balance things out. It's a hedge against certain other investments. And then in addition to that, rental properties can provide a very good return if you do it right. It could be 8%, 10% if you're really not using hardly any leverage or borrowings to purchase that property. It could be 25%, 30% if you use leverage like loans. And I'll go through an example to show you how that might work. So there's some very good pros. Okay, so now let's look at some of the cons of owning and investing in real estate. You can lose money, and I want to say that again, you can lose money. And you can lose a significant amount of money if you don't do it correctly. So you have to keep that in mind. The rent for that property has to cover all the expenses. The principal and interest if you have a loan, your real estate taxes, insurance, your utilities, etc. All your expenses. And you have to make those payments whether or not you collect that rent from the tenant. So if the tenant doesn't pay you, you still have to come up with your own money and pay off, make your monthly mortgage payment or make your utility payments, etc. So you can lose money. You're the landlord. So, you got to make sure that you understand this is a business. This is not a game. You're the landlord. You're the one who's in charge of collecting the rent, of setting what the rent is, making all the payments, finding vendors if something breaks, etc. You have to do all that. So it can put stress on you, especially if you're working in a normal job and you're doing this on the side. Repairs, you have to make those repairs. And I would say anytime that a tenant calls you and there's an issue, get on it. You want to make sure you keep that tenant happy, but you're the one who's going to have to pay for those repairs. Your tenants don't do that. Now, if they broke a window or something like that, you can charge them. But for the most part, if the furnace goes out or the AC goes out, you're going to be making those payments, not the tenant. And then if you're not familiar with how to do something, another con is you're going to have to hire an expert, whether it's a plumber or an electrician or an attorney or an accountant for tax problems or tax questions, whatever it is. You might need to get expert help. So that is a con. You're gonna have to pay them to help you, do whatever, help you solve whatever the problem is. Okay, do's and don'ts. Do work with a trusted real estate agent. They'll help you in many, many ways. They'll help you stay out of certain locations and focus on others. They'll help you find properties within a 10 or 15 mile radius, which I would suggest you stick to it first, because if there's a problem, you don't want to be trying to drive 50 miles away or 100 miles away to deal with that problem. You want it somewhat local. You want to become familiar with your local area, familiar with your local rents, etc. And a trusted real estate agent can really help you understand all that. It's best if you find motivated sellers like a bank. I bought a lot of my properties from banks. They cannot keep unperforming assets on their books. They need to sell those. Well, your real estate agent can help you find those kind of transactions as well. Do one property aside, so I would, at a time. So I would say number 2 is definitely one property at a time. Don't try to buy 2 at a time, 3, etc. Do one. Make sure you're comfortable with one. All the ins and outs of owning a property, becoming a landlord, understanding, the legalese related to that property, etc. So do one at a time. Once you become familiar, you can expand, but at first stick to one. Again, understand the rent of the area. That rent has to be able to cover all your expenses. So I'm going to walk through a Schedule E, which is the income statement, here in a minute, but you've got to understand the math. Try to get pre-approved by a lender. So talk to some lenders, see if you can get pre-approved for a certain amount, and then that will help you determine what kind of property you can buy, how high you can go, etc. So work with a lender. If you have a pre-approved letter and you walk into a seller transaction with that letter, now they know you're serious and you can afford, to purchase this property. Also, before you hand over the property to a tenant, after they've signed the lease agreement, etc., and you've done background checks, etc., make sure you guys walk through the property and make sure that everything's working. Any appliances that you have to be working, the electric's working, all the plumbing's working, the toilets are flushing, the faucets are working, the shower's working, etc. And make sure that your smoke detectors are installed and working. That way, if there's any issues, if there's a fire or anything like that, you don't want anyone to come to you and say, oh, well, you didn't have smoke detectors in the apartment. Yes, you did. And you had them sign off at the beginning that they were working, so that protects you. Make sure that they're working. Understand the eviction process. Do you need an attorney to help you with that? Some counties require that, others don't. But understand, what the paperwork looks like, where you file it, how many days you have to wait, those kinds of things. And consider using a management company. They can, certainly at first, they can help keep you out of trouble. They can explain how all the different processes work. They have the forms, they have vendors that they know how to use, etc. You have to pay them, obviously, but you can do that at the beginning while you're understanding how to become a landlord. And then as you move forward, you can choose to stick with them or kind of do it on your own. Or if you decide to grow your business, you can certainly maybe find a really good property manager and they can help you grow your business. All right, so now let's talk about the Schedule E. And again, a Schedule E is nothing more than the IRS's version of the income statement. So your rental property, you need to show your rental income here. If you have lost rent, you would record that basically here by, in effect, taking it out of the income. I'm not showing any lost rent in this example. Then you have your various expenses, advertising and auto expense, repairs and maintenance and other labor that you might have, management fees or legal fees, insurance, real estate taxes, interest on your mortgage. The principal is not a deduction, but the interest is. Then the various utilities, water, sewer, trash, gas and electric. And then if you have lawn care or snow removal, and then any other miscellaneous expenses. So that's what a Schedule E looks like. You record your income, you deduct all your different expenses. In this case, I'm showing basically $16,000 of cash expenses and then another $4,600 of depreciation expense. That's a non-cash expense, but when it comes to paying taxes, you get to depreciate your building. So if you had a $150,000 building that you purchased, basically I'm saying 15% of that is related to the land. You don't get to deduct the land value, but the 85% you do get to deduct. So in this case, you take the 150,000 times 0.85, that's the 85%, divided by 27.5 years. That's the number of years that you can take your depreciation expense over. And in this example, it's $4,600 a year. And what's important about that is this non-cash expense protects the income. So you're not paying tax on $4,600 of income that you might be earning on that property. So in my example here, you had 21,600 of rental income, and you had 21,360 of expenses, of which 4,600 was non-cash. So you're paying taxes on that difference of $240. The cash is this $240 plus the depreciation expense. So you really did make almost $5,000 in cash. And then you also paid down, in my example, about $1,200 of principal when you made your monthly mortgage payments. So we're going to say that the sum of those two is $6,100. We're going to say that you pay, in order to purchase this property, you put down $30,000 for a down payment, and you paid about $3,000 in closing costs. So you have $33,000 invested in cash. So your return on investment on your cash is about 18% in this example. Now it can be higher, it can be lower, depending on what happens in that year. If you have certain expenses, if you don't have certain expenses, etc. Then in addition to that, hopefully your property went up in value and you got appreciation. I'm assuming a 2% increase in your value of your property. It could be more, it could be less. But if that were the case, you'd make another $3,000 on that property. So at the end of the year, it'd be worth $153,000 instead of $150,000 that you paid for it. So you basically had an all-in investment of almost 27% return. So that's why one of the main benefits that real estate offers you. All right, so to summarize, you can see with these numbers, an 18, if the investment turned out as I've got here, and again, this is just an example, you would make 18.5%, which is a pretty good return on your cash, and you could make up 27% in this example if you include in non-cash appreciation. So to summarize, you have risks. If you're getting a loan, you're going to have debt. Dave Ramsey, those types of folks, they would say, be careful because you have debt. Most people need debt to buy real estate. Real estate's expensive. It's not, you can't buy, a piece of real estate for $5,000 generally. You're going to have to come up with some money. So, and most people, they're going to need to take a loan. They're going to use the leverage, and they're going to treat this as a long-term investment. So it can be a very good investment, in my opinion, but it does carry some risk and it does require some work.